Okay, so Randy, here we are again. Now, you're mainly a property guy. You're a buy and hold rental guy. You have been for years, right? That's your main model.
Right, exactly right.
Okay, but if you sell, you don't sell for cash. You sell on a contract, on an installment basis, which for you in Illinois is sales contract, land contract, contract for deed. And in my part of town, it'd be more likely for us to do a straight owner carry back with a note and deed of trust and all of that. I was curious, are you considered a dealer where you have to pay all your capital gains in the year that you sell, even though you sell on a contract?
Well, no, is a short answer. Now you do have to be careful not to sell too many properties per year. But I mean, if you only had say 20 properties and you were selling five a year, I think the IRS could argue that you are a dealer at least for 4 years.
Right.
Um,
So that
but
that
if
could really ruin the cash flow on those. That'd be
Oh gosh,
tough.
yeah,
Yeah.
yeah, it just ruins everything, capital gains and everything. So the trick is to just sell a few a year. But yeah, I mean, it became very obvious as the interest rates dropped a few years back that if I sold for cash, well, what am I going to do with the cash? Take it to the bank and get 0.0003% return on it.
Yeah.
Uh, Whereas if I sell on a contract at 7% to somebody who can't yet qualify for a conventional loan, then I'm getting basically 700% higher return than putting the money in the bank.
Right. So you're mostly buy and hold, but when you do sell, you sell on contract, on installment, making 7% instead of 1% or less at the bank. And so basically, you're a note holder. Have you ever sold a note or sold a contract?
I've sold notes before, but never sold a contract.
When did you end up with notes?
Well, that's been years back when I sold and sold a property and got some cash and some note, but not like you do. I mean, you're in the note business and you're buying and selling notes all the time, and that's how you make a living. So, I'd be curious to hear from you right now, for example, in this market environment. What is a fair discount on a note? If I come to you and I've got a property that's securing a $10,000 note, and everything else being equal, the property, there's enough equity, and you feel comfortable with it. What's a comfortable discount for me to get on that note?
Yeah, well, I can appreciate you ask. This is a common question and one that people think that you can answer with in one sentence. Unfortunately, if you bring me a $10,000 note and I'm assuming that the property, let's say it's worth 100,000, so I've got a 10% position, 10% LTV note, let's say. Is that fair enough? So your note,
Okay.
and I could have another note that's 10%, $10,000 note on another $100,000 property, depending on the terms, the interest rate, the amortization. I might be able to pay 8,000 for your note, and on the other note, I might only be able to pay 5,000. They're both very, very safe, but what am I looking at after safety? After I've determined it's super, super safe, what do I have to make? Now I'm figuring out what's my yield. And so even if it's safe, I don't want to make a 3% return or even a 5% return or even an 8% return. For me, I'd have to minimum probably get a 12% return. So whatever, if you have amortized that $10,000 note over 30 years at 5% interest, I can probably only pay 5,000 no matter how safe it is. It's just that it's out so long. And I'm sure Randy, time value of money, that last payment at the end, in terms of today's dollars, even if you say inflation's only at 3%, it might only be worth, 5 cents in terms of today's dollars.
Well, yeah, I agree with that. But wouldn't you also say, Don, that most of the notes that you run into out there have balloons on them, that they're not just a 30-year note on a piece of property
You'd
with,
be surprised. Now, sometimes I like a balloon, but sometimes I don't like a balloon. If there's an obvious exit strategy, then it's an advantage and it's going to increase my yield and the price I can pay for the note. But if it's unlikely that note payer is going to be able to hit the balloon, it's a more of a liability than anything. So it just really depends. And if it's an owner-occupied situation, I don't like balloons. I don't like balloons for owner-occupied. Yeah. Hey, well, great talking to you. Thanks for the questions, and we'll do more of this next time. You have a great